Hello and welcome to WooStream, bringing Willamette to you. My name is Tiffany Newton and I'm the Director of Alumni and Parent Engagement here at Willamette University. I am privileged to introduce our moderator, Professor Rohan Grey, and our speakers, Joan, Reukauf, and Tim Myers this evening. Rohan Grey is an assistant professor of law at Willamette University's College of Law. His research focuses on the legal design and regulation of money and finance, including digital fiat currency, as well as broader issues of law and political economy. Joan Reukauf, MBA 15, is a contributing assistant professor for Willamette's Atkinson Graduate School of Management and serves as the EVP and Chief Operating Officer at People's Bank of Commerce. She also was recently elected chair of the Oregon Bankers Association, Oregon's only trade association dedicated to the banking industry and its customers. Tim Myers, BA 93, serves as the Bank of Marin's President and Chief Executive Officer, having joined the institution in 2007. A nearly 30-year financial services veteran, he has held leadership roles at various financial institutions, including Vice President and Commercial Banking Officer at U.S. Bank, National Association, and Comerica Bank. He is also a community volunteer and advocate, focusing on programs that support youth and families. Today, Professor Grey will guide the conversation around current issues impacting financial institutions and markets while getting insider perspectives from our alumni experts. Please join me in welcoming Professor Grey and our speakers.
Thank you very much. And thank you so much to these speakers for joining us. I will try to keep my remarks very short and sort of just around the edges. And I will sort of ask each of you and take turns to comment on each large, broad question. And then we can go from there to the Q&A and have a bit of a discussion. So maybe, Joan, I'll start with you. Would you mind just giving us a sort of overview about what's been going on from your perspective? The last few weeks are one of those periods where it feels like decades are happening. And I think compared to some of these other crises that we've experienced, Tiffany was making a joke earlier that we've had, one of these crises a decade. I think what feels different to me, at least, is that in a lot of these other crises, you see a lot of concern and a lot of supplementary or concurrent issues going on in the real economy and other industries and other sectors. And so often the specific technical aspects of banking get submerged behind a broader need to just put out the fires in the whole economy. But I think both the crises this time and the response have been very acutely focused on banking specifically and in a very short period of time. And that's allowed us to develop a narrative or kind of get the public awareness about the specific technical elements that have gone on here in a way that feels somewhat different to me, at least. So maybe you could give us a bit of an overview from your insider point of view.
Yeah, I think you make a good point. Speaking of not only to any kind of crisis that may have, a banking theme to it, but there's also usually some other things going on economically that we can look at as well. This is no different. We're still trying to recover from a 2 or 3 year, how you look at it, pandemic, still trying to get our supply chains back in order, still trying to, control inflation. And so, there's a lot of these things in play, right? From my point of view, I work for a very small community bank, which I hope to stress the importance of through this venue a little bit. I know, I'm sure Tim will echo some of those sentiments as well. But, in my world, yes, we saw an upheaval. It's funny that you mentioned it feels like it's been a decade, because I just wrote an article today and I talked about, March 13th, and that was the day that we all had to prepare for. And it felt like, God, that does feel like 10 years ago. It felt like it's been a while, but from my perspective, and I can speak from the community bank point of view and those smaller banks, they're to us, and I saw a question in the chat about some of those regional banks and smaller banks and deposits flowing out to bigger banks because of what happened. There's a few things. I think if we look at all the crises that we've had in the past, and something that I feel good about because I've seen it this time versus maybe in 2008, we have a much more, at least it feels like, and I'd love to hear Tim's perspective, educated public that know just a little bit more about the banking banking system. And I'm going to say that probably is stemming from back in our last crisis. Not as much as I'd love for them to know, because certainly this was a unique situation that happened with Silicon Valley Bank. And so getting painted with a wide brush that Silicon Valley Bank went out with is completely wrong in this scenario. But I think, when you think about what we've just lived through in the past, just even 5 years, this is just one more thing for us to try to get through. How do we do this? And the fact that the focus seemed to be shoring up our banking system, well, I think that they made the right move in that, now we're in that, well, what's next? Right. And again, speaking from a small community bank perspective, when you come out and you say that we're going to support all of those too big to fail banks, but don't speak to community banks and regional banks at the same time, that to me poses a problem. So I'm very happy with what happened in that we restored some of that confidence in our consumers and businesses that the U.S. banking system is just fine, it's resilient, it's going to move forward. We still have some work to do in that perspective.
Thank you, Tim.
Yeah, Joan, that was a great answer. And when I look back to the last crisis, there's always similarities and differences, right? So there were some price bubbles here. It wasn't the large, bubble that we saw with asset values that led to tremendous leverage in the financial engineering behind that that led to a dramatic explosion last time. And I do think we have a much more educated public, but we also have a much more educated press corps around that is much more attuned to problems in the financial services industry. And they responded much more quickly, and they weren't going to get caught napping this time. And the fear factor, I wanted to, scream from the rooftops to customers during this, the FDR quote about have nothing to fear but fear itself. But the problem is fear in banking can be a hand grenade, right? And that is really what happened. And I think it's easy to lose sight of. We just had the second, third largest bank failures in U.S. history. Now, they aren't the same household names as Lehman Brothers or some of the failures we had before, but our industry, by and large, from the investor standpoint, had been under pressure for some time. And I don't want to pontificate too much here, but if you talk about $4.5 trillion entering the banking system during the pandemic, and everyone's deposits ballooned up, that put real earnings pressure on banks about what to do. And there's been plenty of articles about this. And banks responded because there was no possible way to lend it out on a normal basis, a non-PPP type basis, to generate returns. And they made investments. And they had made investments in things banks have always made investments in: treasuries, government agency, AAA rated bonds, things that are safe. And then because of that, convergence of liquidity in the system, the supply chain issues that came out of the pandemic, that drove an inflationary response that ultimately the monetary response had to be to bring that down. And all those things came together. And that is a unique situation, and that caused a banking crisis. But nonetheless, there were some bubbles there. If you look at what happened with Silvergate, which kind of led us a little bit into this from a perspective standpoint, that was a community bank that pivoted to, by and large, a crypto-focused or a digital asset bank. Signature had 20% of its deposits in that category. Silicon Valley had tripled in size between 2019 and 2021, largely centered in a very, in an industry that, was bubble-like. And so it only takes one thing, and nobody knows what that one thing is to prick that bubble. And then you have the fallout. In this case, it was a fallout of crisis of confidence because you had the press, the analysts, regulators, everybody saying, be careful of banks with investment portfolios, be careful of banks with a high non-FDIC insured deposit base, which is going to be almost any commercial bank, right? And then you saw the fallout with First Republic over that. And banks in our area that have that. And on top of that, you've had this concern because of the pandemic around commercial real estate, and everyone's been very focused on that as well, and who might be exposed to that, particularly in urban areas where, I'm much more in the crosshairs of that than Jones Bank. And now they relate all that. And so you have this ongoing crisis of fear and or confidence that it does take some time to get out of. And we had $300 billion leave the industry into money market funds, this year. about 100 billion has left smaller banks into the money center or the top 25 banks. But as someone in the chat pointed out, I think we had 5 billion come back last week. So I do think it is calming, but there is going to be a period of, penance or regaining confidence, with the investing and our customer communities for all the banks that aren't in the too big to fail category, which again, ironically, were the ones that led us into the last crisis. We were by and large the flight to safety. And so, there's always similarities and huge difference.
Well, and if I could tack onto that, Tim, the other phenomenon about what's going on right now is the speed of payments and social media. So those two things, if you think about some of the triggers that happened for SVB and then the quickness, the speed that deposits were able to fly out of that bank. It's the first digital run on a bank that we've seen. And so it causes us to all pause and sort of think about what does that mean for the future? If you think about in the past, it did take a little while for those runs to actually run out, which you could maybe react to. There's no way to react to this one. So that was an interesting feature to me.
Yeah, I'll just add one thing to that, and Joan is not corrected in any way. Yeah, social media played a big deal in it, but it was also customer concentration and correlation, right?
Oh, yes.
And that was a unique aspect of Silicon Valley Bank, and that such a large proportion of their clients were on the same email chains. So I do think the ability to move money on your phone mobily and all that had to, contribute to that $42 billion run in one day. But they were all on the same email chains. I was getting calls the Thursday prior saying, I hear people can't log into their accounts. I hear people's wire requests aren't being honored. And when everyone knows everyone and they're all tied to the same VCs, I don't want to throw them under the bus because, especially for me on the wine industry, they've always been a fierce competitor. But that was a concentration risk that really doesn't exist in any other bank I know about there.
Thank you. Yeah. So, I want to just tie a few of these threads together and see what your thoughts are, because both of you kind of mentioned the unique aspects here about this hitting, or at least the kind of face of this being smaller or regional banks as opposed to those too big to fail banks. And at least to me, putting these pieces together, first of all, as you said, there was a lot of money going into these banks rather than this being a kind of loan driven and asset side driven issue. This was, what do you do with all these deposits that have come in? How do you invest them? And then it's easy enough to say, let's invest them in safe treasury securities or mortgage-backed securities. And certainly I think the regulatory environment, some of the changes in 2018 that allowed fixed rate long-term debt to be considered part of the high-quality liquid assets without a concern for the mark-to-market value changes meant that when rates did go up, suddenly these assets were less liquid than they needed to be to get out without significant losses. And that's fine until, as you say, trust goes down and then that run becomes self-fulfilling. So on one hand, we had sort of money looking for a place to be safe and yield earning and liquid. And the regulatory framework that treated treasury debt, long-term treasury debt like that, wasn't actually reflective of how those long-term securities react in the market. Then you've got this second point, as you mentioned, the concentration of the industry and the fact that not only was this quite ironically or symbolically, as well as for the social media age, located in Silicon Valley in California, it was a particular industry. It was sort of the least sympathetic of maybe all the industries at the moment. And specifically with this crypto edge and thinking about Silicon Valley Bank having, I think it was Circle as one of their customers, had something like $3 billion unsecured in deposits there. And other companies like Roku having $500 million in their cash management. This question of where were the cash managers in these companies? And it's sort of like maybe this is actually part of the industry that this isn't a priority for them. And this bank was kind of covering for them, but also the bank requiring a number of the loans that they issued to then hold their deposits at that bank, which was sort of exacerbating the internal concentration risk, and then offering specific benefits to the CEOs and the early founders of those companies to keep their funds there as well, which meant when the crisis happened, it really was localized. But I just want to go back to this idea of kind of big banks versus small and regional banks, because it seems like what we saw after 2008 was a kind of implicit and explicit, to a degree, commitment to not let those banks fail, to the extent that uninsured deposits there were not really uninsured, even if the regulatory treatment hadn't caught up. And what we're seeing now is the two-tier system that created in terms of protections and guarantees, creating a very unfair dynamic and unfair environment. And I'm just wondering, from your point of view, where you see the next sort of steps or where you see that kind of dynamic going, because I've seen at least, Secretary Yellen get grilled pretty hard in Congress by people on behalf of small and regional banks. And certainly as I think someone mentioned in the comments, the dual contradiction between Chairman Powell saying your deposits are safe and then Yellen saying we're not going to guarantee these. It seems like there's a bit of an identity crisis in the world of FDIC insurance right now. And I'm just wondering where, from your perspective on the ground, you see this sort of two-tiered treatment playing out.
Yeah, I'll start, Tim, and I'll just comment, but I'll leave some for you because I bet we have kind of the same answer on this. I was just at an American Bankers Association seminar, and one of the big topics, of course, was how are the small and regional banks, going to show that they're protected. Back in 2010, 2012, there was something called the TAG program, so a temporary guarantee on accounts. A temporary account guarantee that had come out. You paid a premium for it. And if you wanted to take part in it, then you could. So smaller banks like me could say, hey, we're all protected, just like the big banks. But of course, you paid for it, right? And no one ever actually used it when we had that. So it just goes to show that those regional small banks can hold their own. I would make the other point that, we can talk all day about too big to fail banks being protected and 100% guaranteed, but guess who's paying for that? It's us smaller banks too, because our assessment goes up. So that's one thing that we're going to really have to talk about as we move forward. And I think what we need to see and what we will see is some sort of reform in the deposit insurance fund and what that may look like going forward.
Can I just jump in on that? And when it comes to the assessment, what we are talking about here is when it comes to formal guarantees, the assessment takes place. When we're talking about these backstop emergency programs, which often go from the biggest banks outwards, we don't have any, recompensation on the back end. The Fed just takes that on their balance sheet and it just gets absorbed into the general macroeconomic environment. So it seems like not only is it a situation now where these smaller banks are covering for the larger banks, but also whatever you do on the back end in an emergency versus doing explicitly creates a different degree of accountability.
Yeah, and don't get me wrong, we need to protect and make sure that our banking system is solid going forward, which today it is. It's resilient. We're healthy. We're doing okay. So sometimes we have to do some of those things. And I never want to make it a big bank versus small bank kind of situation. We're all banks. We all have a part to play. But we need to have a good conversation about how to move forward with this.
Agreed. I think, the 2018 Crapo amendment, or was it 2155 that raised the threshold for banks that were being deemed too big to fail, or had much tighter liquidity coverage calculations or supplemental leverage calculations that compensated for some of the things, Rohan, that you were talking about, what qualified as liquidity, how you had to adjust capital, the stress test to determine whether a bank could cover all its outflows. If 100% outflows, there's no question, given that Silicon Valley Bank was just north of 200 billion, Signature just north of 100 billion. But when you push that down, smaller banks weren't able, and that you can debate where that threshold is, really weren't able to do those things without having to raise capital. And having to raise capital, if you're a publicly traded bank, you can't always find a profitability model to justify that return. And so there was a bit of a threat to an existence for smaller banks when you were looking at that regulatory framework. But there's always a trickle-down effect. And so I've had conversations with, Kathy Moe, who runs the FDIC in the West, about how they're going to look at smaller banks. And it may not be one ratio, but it may be a matrix of things where if your capital's here and your liquidity's here and your potential hit to equity from unrealized losses is here, we'll support your efforts, or we might come down and criticize what you're doing. So I think it'll be a more nuanced look for the smaller banks. But at the end of the day, and I'm always torn on this because, yes, the smaller banks are going to bear the brunt of the cost of any amount that the regulators pay out to depositors. I think it was 20 billion that I saw, and I may not have that number right on Silicon Valley. And that'll be higher assessments to Joan and myself. But it also isn't taxpayer money, which has the propensity to ignite a whole firestorm of political discourse that may end up in legislation or things that don't really benefit banks or consumers or commercial customers. And so while that will be unpleasant, I think the regulators still have a lot of leeway in how they're going to respond to this. They really did before. And I think if you saw Michael Barr's or read the transcript from his testimony the other day, the Senate, they're already saying what they're telegraphing what they're going to do by lowering those thresholds, requiring long-term debt to provide more support for the balance sheet. And so I think the regulators are going to get directly involved. There was a lot already involved. They're not happy about what happened. There's a lot of egg on some faces there. And I think they're going to voluntarily offer to do a lot more that should appease some of the political tensions around it.
Yeah, so I have another question on this, and then maybe we'll go into some of the broader historical context and the larger kind of arc of these developments. But you mentioned earlier, not wanting to frame this as big and small banks, but I think another vector that's come out of this, and probably also going to have long-term implications, is the American versus non-American dimension to all of this. A lot of the Basel reforms that came out after 2008, there were sort of agreements and consensus internationally, and then the US particularly put certain exemptions for banks in that medium 100 billion to 250 billion category that a lot of the other countries didn't put in. And I think what we're seeing now, first of all, with Credit Suisse going into distress and then having to be purchased by UBS, and then more generally, just the recognition that this was a crisis that other countries' regulatory environments, not that there isn't a larger problem maybe with uninsured deposits, which I like to get to, but this idea that this particular medium to sort of large size bank might have not actually been replicable in other regulatory regimes. And this question of what happens when the US gets to not only sort of set the standards internationally, but then give themselves an exemption. So I'm just wondering, are you seeing any kind of international dynamics here? Are you, obviously, you maybe you're more focused regionally and locally, but are you seeing any kind of conversations about what might happen next, being ones where there's pressure internationally, or is this primarily a US sort of located discussion?
It's been very local for us, although I have heard that they're going to accelerate the implementation of the Basel Endgame requirements for, banks down to that threshold you were talking about. I think you'll see the acceleration and push down of a number of requirements they've been working on, but it's still a very domestic flavor. Still even within, the research organizations, the regulatory reports, it's very much a U.S. flavor about what's been going on. And frankly, while Credit Suisse was by far the largest of all these, that's been a train wreck, coming down for decades. And, it happened in their regulatory environment. But I have not seen that effect. If I was a money center bank, my answer might be different, but I haven't seen much of that. And I don't want to speak for Joan.
Yeah. I would agree. Not that a global picture isn't important, because it is. So I think that will still enter into the conversation. But from what I've seen, it really is staying domestic.
Yeah, I mean, one thing I've noticed is that we saw the kind of reactivation of a lot of the swap line networks, the international currency swap lines at this point. And so to Tim's earlier point about every time you rely on the public money to do the bailout rather than internal assessment on banks, there's a different kind of regulatory response. So I'm curious about where that's coming down. But I maybe want to zoom out a little bit, because going back to this idea of, the traditional bank run, and there's a sense in which we think after the 1930s, that Mary Poppins style bank run is supposed to be done. We're not supposed to be dealing with that anymore. It's supposed to be an image of the past. But there's a sense in which 2008 to a significant degree, and other crises, certainly the savings and loan crisis in the 80s and others, were crises of bank runs primarily around uninsured deposits. And it seems like we have at this moment a kind of system where for your average person, you think of your bank account as one kind of money, but there's in fact two kinds always within there, very, very different risk profiles and everything else. And there's at least to me, a kind of almost fiction that this distinction is going to be maintained in the breach. And what we see over and over, whether it's the FDIC stepping in to commandeer or to direct receivership processes, or eventually to tap its fund. And of course, after the 90s, there was this move to say, you have to use whatever the least cost method is unless you have a systemic risk. And they declared that this time in a way that I think a lot of the lawyers are going to spend a fair bit of time debating for a while about what the actual definition of a systemic risk is when you have a small number of localized banks, and that still qualifies. But, from your point of view, do you see an ongoing kind of social or industry benefit for having this sort of market discipline being imposed on the uninsured depositors? Because what I'm seeing, it creates this different sets of winners and losers within the industry, and a series of risks for the depositors that don't actually seem to be generating the market discipline that the uninsured depositors are supposed to be providing. You know, I have colleagues that will say the hard lesson here is that the liability side is not the place to impose market discipline. We should be looking at other places. But do you think there's some hope left for depositors serving that kind of disciplinary function on banking activity versus, you know, shareholders or asset, you know, regulations and things like that?
Joan, do you mind if I start? Or
No, go for it.
I mean, I think they're doing it now, but it's always in hindsight. It's always reactionary, right? And again, I'm not trying to blame the pandemic for everything, but you know, it was fun for a while. But you know, you had this 12-year period where the economy was good, money was free, people really weren't earning anything on their money, and you had, you know, if you look at our bank alone, $700 million of deposits that went up during the pandemic, all the PPP money we lent out, we all kept staring at it saying, when's it going to go down? It didn't go down. And you had this huge influx and nobody could earn anything on their money. And I think you go through a long period of no credit cycles, no bank implosions. There's not a lot of viable options from a return standpoint. And I think people got complacent. So I think there's a moral hazard, Rowan, risk on both the depositor side and the lender side. And I would never blame the depositor, but it was a confidence that, well, normally I would have $3 million in my account and some of that rest would be in a money market fund somewhere, investing in some pool of treasuries or AAA rated, you know, agency bonds. I'll just keep it in my account. It's simpler, right? And so that is what we've seen over the last, you know, month is a huge amount of, you know, since, you know, rates went up in 2023, there was a JP Morgan report that said $1 trillion has left the vulnerable banks and about half of that into, you know, money center banks. And so that predates obviously the SVB crisis, but and the other half into money market funds. And so I think they're remedying that. You know, we've certainly seen the impact of money going to money market funds at brokerages. And maybe that should have been the case. Of course, as bankers, we would always say we're a safe, sound institution and we want to hold your money, but it is rationalizing that decision from an academic standpoint, in my opinion, if I understood your question correctly.
Yeah, that's a good point. I focused in on your word complacency because we just went through a very unusual time where none of us knew how to react, how to move forward. You know, in some instances, especially at the beginning of the pandemic, it was day by day. You know, how do we do this? At the onset of the pandemic and right in the middle of it, I was CEO of a small community bank, and boy, I don't know about you, Tim, but that was a day by day situation. What's going to happen tomorrow? How do we get through this? You know, once PPP hit, that sort of took all of your attention, and it felt good to be able to help out. But again, we sat there and looked at all these deposits going, okay, now what? You know, these things have either got to move out or we've got to be able to loan it out, which we couldn't loan it out. And so it's one of those things where I think that what I heard Tim say is, number one, a lot of this, you can look at a cyclical kind of thing. We sort of go through ebbs and flows with this stuff. If you look at the history of banking, all of this sort of cycles through, right? And it cycles through differently with different things that burst, that implode, whatever it might be. We are just coming out of a time when we had no clue how to manage what was happening, and we managed on the fly. I'd like to think we did a pretty good job, but now we're dealing with things and looking back on it saying, oh, okay, that's what that did. Now what do we do going forward? So again, I don't think you can put blame anywhere on this. This is for our well-managed banks that are still out there, still resilient, still doing well. I think that they're doing it right. But again, what else could happen that maybe we're not foreseeing because of what's been going on in the last 5 years?
I think that's a great point. And one thing that's hard, and I know one of your questions was for the audience about resources they can use. One of the things that's hard about banking, I mean, we're not tech startups reinventing the world, right? It's not rocket science what we do, but it's incredibly complex in the accounting and the financial performance over cycles, and is a bit like, you know, reading hieroglyphics for people in terms of understanding how a bank does. What exacerbates that for the consumer or the commercial customer is that the regulatory review of banks is so opaque, right? There is no, they promised we'll get a report on May 1st, including confidential info on what happened at Silicon Valley Bank. But Camel's ratings are, you are sworn to secrecy, for good reason. That causes runs on banks, right? But, other than analyst reports about how a bank's doing, which are by and large for bigger banks predicated on their own estimates, for smaller banks, they're guessing based on trends. It's really hard for people to see in, especially over a period like we've had of 12 years of no problems. Within all that blocking and tackling, is everybody doing it right? You just aren't privy to that. And for a long time, markets don't know and don't reward or penalize. So it really can be confusing to observers, customers, even the bank employees to know, is anything going wrong? Are we headed towards some kind of impending issue, or is everything going great? Because that's just info that people don't get access to. So I think that plays a role in that complacency within our own industry or customers or whatever that builds until something pops a bubble of some kind.
Yeah, I mean, anyone that knows me knows I'm not going to be, I'm not super sympathetic on the banking industry. But to your point about complacency, it seems like it's not only just a problem of your reaction, but it is the environment that's evolving and the structural problems that have been latent for a while in the way that we've approached this regulatorily. I mean, to your point earlier, if actors did go into money market funds, then what would be the safe assets that they would be investing in? It would also be treasury securities and things that have similar duration risk. And we've seen what it looks like when large prime money market funds try to play the duration curve and get burned with rate increases, whether it's long-term capital management or something else. And so it seems to me one of the challenges we're having at a systemic level is that there is a demand for safe assets that have some reasonable degree of yield, but there is just a very limited range of options for average people to find those safe assets. And whether we're looking at stable coins on the crypto side, and I think again the fact that USDC had $3 billion in uninsured deposits sitting at this bank while claiming out there in their public materials that they had everything that was safe and guaranteed and one-to-one backed, etc. I mean, there was almost a rhetorical dodge going on there to give the impression that they were finding that magical pot of safety for consumer funds. But then on the other side of things, if you're saying the alternative is to go into money market funds, and then that has its own limitations on the payment side, people don't want to be creating 3 different tiers of basic money instruments. But then when you have actors like the narrow bank trying to get a master account at the Fed and being denied, and this idea that the Federal Reserve and federal regulators really don't seem to want to let something like a narrow bank exist for people to store their funds, So it seems to me, not to sort of be too crudely reductive, but if part of the 2008 problem was that there was a search for assets to invest in and that kind of got weaker and weaker in quality, this was almost the opposite. They were trying to not go into risky assets and sort of go into increasingly arcane forms of credit instruments and derivatives and things. They were trying to keep it pretty close to the core, and that still wasn't good enough. So I don't know. I mean, again, dare I try to take the bank side on this, but complacency, it almost feels like there was a kind of damned if you do, damned if you don't dynamic once all of that liquidity hit your banks and those depositors were sitting there with funds. I mean, do you see a need for a kind of safe public instrument larger than what the deposit insurance caps provide right now? I know there was a moment that's sort of coming out with all the dust settling now that it seems like there are about 10 customers at Silicon Valley Bank that were the primary recipients here. So it's not a particularly sympathetic customer base. On the other hand, the issue seems more structural than any individual one depositor.
You're talking about if it's the FDIC, it's taxpayer burden money if someone has to draw on that insurance, right? Certainly the 250 was more aimed at the consumer, and the consumer-oriented banks right now do have by far the largest percentage of fully FDIC insured deposits. It's the commercial banks, and I say this, and Joan, don't worry, I will get on the community bank bandwagon. And toot our horn, because I think intent and action and behavior all play a key role in how these play out through cycles. But we have a lot of large commercial customers. Unless it's a pizza shop, it's going to be more than $250,000. And that's no knock on pizza shops. That's just natural. And it is hard for a 20 million revenue widget manufacturer, metal shop, to say, well, I've got this banking relationship here, and my money market funds here, and my digital currency here, and they can't manage all that. And so they want to believe it's safe. We want to safely provide that to them. And so we have an obligation to, again, operate safe and sound institutions. And by and large, the vast, vast majority of us do. But because it is such a game of crisis, I think Mohammed El-Arian had an article the other day where he was saying a lot of great banks are going to be punished right now because it is a game of a crisis of confidence, and banking is a game of confidence. And we get set back years whenever we go through this, whatever that downturn is or the reason for it. I've never worked for a bank that was part of the cause of that, but everywhere I've worked has bared the brunt of how the customers respond to that, whether it's retail consumers or commercial banking customers. And it's hard, and you have to work very hard to earn that back. And Rohan, I would never pretend to ask you to be on our side. As an industry, we shoot ourselves in the foot quite a bit. But just like any industry, there are good players and bad. And again, oftentimes it goes back to intent and practice and how hard you were pushing that envelope to benefit from profit on the edges. Because again, there's only not a lot of ways to skin the cat we have. It's just doing it right. And we have to earn that confidence back.
Yeah, it's almost it's an interesting situation because I know that a major question, I saw it come up in the chat, how do you gauge your bank? How do you know that your bank is doing what they should be doing? And Tim had a great answer. Sometimes that's very hard and you can't. And I'm going to flip it where when you are with a small bank like mine or like Tim's, a regional bank, and you can have access to the leadership and you can have those conversations, that's powerful. And so, making sure that you are able to find those good actors in the banking industry. Tim well said, as with every industry, there are good actors and there are bad actors. And that's unfortunate for us. And I think what we will see, and I'm so interested to see what's going to play out with all of this investigating, because I don't want to say anyone acted badly, but I think we'll start to see, and I know from a bank leadership and executive position, I want to see what happened. What did they do? What decisions were made? Number one, so I don't make them moving forward, but what were the, what was the timeline? What led to what? So that we can really see what that looked like, so that we can shore it up. And I again think, at great point, Tim, it's the commercial bank aspect of this all that we really need to think about. I think that the consumer pieces of this really do get a lot of the protection, but to Tim's point, you can't have a $20 million company trying to do their payroll and expect to be underneath the FDIC insurance coverage. That's not how that works. So hence, I think what we'll see coming is maybe a reform of that or some other way to be able to move forward with that.
Yeah, I had a colleague who was in the treasury at Goldman Sachs. And, I said to him, if you could just put all your money in an insured deposit account, if there was unlimited deposit insurance, would you go through this whole rigmarole? Maybe every now and again when the yields are so good on short-term T-bills and things, but is it actually worth it? He said, probably not. We'd probably just park it there. But that option is not available to us, right? It's not available to us in the way that it's available to others. And I think to your point, Tim, and Joan, the idea that, those mid-level companies, not the massive ones that can afford whole departments of anybody, but the ones who've got, a small HR department, things like that. The idea that they're going to hire 3 to 4 money managers or something, it's a huge cost to their business model versus the simplicity of parking it. And, it sounds like some of these actors did take a risk by parking their money here and it got burned as a result. But the other side of it, I think, to your point, there were some serious governance failures, specifically with Silicon Valley Bank here, to the point where their risk manager left and they didn't hire someone else, or they changed some of their internal models. And I think, again, plenty of blame to go to them, but also at this systemic level, it feels like the game was almost set up for them to fail too. And I'm just curious from your point of view, if we do have a situation where the regulatory environment says high quality liquid assets can include long-term bonds, and there is this need, and, we're in a moment now where there's been a significant large amount of deficit spending that has put a lot of treasury securities into the system. But as recently as 2011, there was a lot of talk about the rise of shadow banking and synthetic MBSs and things coming out specifically to try to meet this unmet demand for safe assets. And if we're not providing them, but there is this sort of fiduciary need to make them available to customers, then it really feels like there's a kind of impossibility that you're all facing absent some deeper sort of financial reform.
I will say it's going to be interesting to see, because if as Michael Barr suggested, they do push down the limits where they do true liquidity coverage ratios, supplemental capital ratios where you're adjusting your capital for the unrealized losses and held to maturity, and you really can cover all your deposit outflows with a certain subset of liquid assets, there are going to be banks that get caught up in that. They're going to have to raise capital, and there hasn't been a lot of capital raised lately. In fact, the ones that have been trying to raise capital since SVB's failure, I think most of them have failed. And so, and the stock prices of the industry overall, I think for the community bank index, it's about where it was in 2004 levels. So, everyone is shooting first and waiting to see how it sorts out, which is pretty normal in our world. It's unfortunate, but it's reasonably normal in these kind of crisis of confidence. Is what does that require the banks to do to be compliant with that? How much grace period do they get? They talked about the Silicon Valley Bank. They had 3 years to get in line with some of the requirements that were put on them. A lot can happen in 3 years. So, the one thing is the desire or the expressed rulings that they make. The other is the execution or the implementation, and how those banks that are below that too big to fail threshold, how they actually get compliant. Because if they do play by the rules of the money center banks or the too big to, what do they call them? The GSIBs, the global, significant banks.
Systemically important.
Systemic, yeah, thank you. That's pretty safe, right? But then you're pushing them into a bigger category. And as Joan and I would argue, there's a whole bunch of us on the other end that are not faced with many of the same risks, that manage day to day for customers, that try to do things the right way and execute on that blocking and tackling for them, and that aren't subject to all that, but don't have the same complexity to manage that don't need to be. So that would be another plug of mine for community banks.
Thanks, Tim.
Yeah, anything, Joan, on that point?
No, I think Tim said it well.
Yeah, I think, and to Tim's point, if the only answer is concentration, then that does lose that access to local accountability that you were talking about, Joan, right? If the only way to survive is to get bigger and bigger, or to have so many liquid assets that you're not actually engaging in much loan making, then you are moving towards a narrow banking model, and then it's credit that's getting starved in the name of deposit safety. So once again, it's sort of like a seesaw. You've only got so much rope on one side. When you pull, the other side goes. So I guess one area that I kind of spend a lot of time on at the federal level is the infinity sign, right? What Neil Kashkari says, we have an infinite amount of liquidity when we need to. And one of the things that was seen to be quite unique in this crisis was that the discount window, or any of these other facilities that we definitely don't call the discount window, the Schmidt window, unlike previous crises and unlike the sort of traditional story in banking regulation of a kind of badge hot rule where you might lend in a crisis against good collateral at a penalty, well, you're seeing collateral being accepted at par in a way that means that what we are essentially doing is liquidating the initial acquisition price for these assets. And to me, to your point, Tim, if we're trying to sort of move to a different system, if we want to let these loans be created and then we want to make sure they're able to be liquidated, then there's one actor that can liquidate all loans indefinitely when they need to in a crisis. And the fact that we've already accepted, at least in theory, that these are acceptable forms of collateral at the discount window, and the only thing that's holding us back is a form of stigma and norm that is perhaps as outdated as the current models themselves have been forced to move on. I look at the United Kingdom, for example, and the United Kingdom has moved in recent years quite softly, but I think quite profoundly, to a system of increasingly pre-positioning of assets, right, where banks will present assets to the Bank of England for evaluation and get a haircut rate that this is the amount that they can be accepted as collateral in a crisis. And so to me, this is one of the most interesting Rubicons that was crossed in this crisis, was that the central bank was willing to say, hey, we will take your collateral at the value you acquired it, right? We let you acquire it. Now we're going to be able to let you get liquidity against it. Do you see a world in which even maybe some of those increased transfer speeds that you were talking about before, the idea that we could be moving to real-time gross settlement, you could see deposit flight in and out of the banking system in general, et cetera, that one way to accommodate that increased volatility of depositor flow is to have a more active central bank balance sheet that is providing liquidity in the breach against any kind of acceptable assets that banks are allowed to issue or acquire?
Well, infinite liquidity is why we're fighting inflation so much right now. So,
right, there needs to be some discipline somewhere else, right, in the system.
It's a double-edged sword, and I don't say that with a political bent, but that is what we're seeing. I mean, the bank borrowings since the SVB collapse have been much more weighted to the Federal Home Loan Bank, where you do take a haircut on those assets and you pledge it to them and they tell you what you can lend. People have been much more reticent, as you pointed out, to borrow against a new Fed facility, because while you're pledging, securities that have held to maturity at par, and that's their way, I think, of saying, we know you have limited capital because, of our monetary policy.
We'll eat the duration risk for you.
We'll eat the duration risk because we can hold it on our balance sheet if we have to, because eventually they will be in the money, right? I mean, that's the thing about a treasury and MBS is at some point by maturity, that all, unrealized loss accretes back. But yeah, if we were to go to a model, I mean, that really has been the Federal Home Loan Bank for smaller banks, the model you described. For bigger banks, it's a good question. I still think there's moral hazard there. You'd have to put pretty tight guardrails around what they could do that on a regular basis as if it wasn't in a crisis. Because as we've seen, loosening things up, eventually people find ways to kind of break through barriers. Sorry, Joan, that was...
No, that's exactly where I was going. When you start to go down that path of allowing certain things to happen, and especially if you allow them not to happen or to happen when there's not a crisis, I think you open yourself up to that next shoe drop, right? And we'll do this all over again of, what caused it? That was... Who would have known that that's what that would have caused? And so I don't know. I think Tim's right. I think that they're the smaller banks, we sort of already work in that world. That is our world when we have to go to the FHLB, but it'll be interesting to see what will come forward for those bigger banks. And is it going to be on a temporary basis? Is it going to be only when there's a crisis? Is it only when there's a crisis at that financial institution, which could cause a whole nother host of issues depending on how the public perceives it?
So now, the one thing, this is a 1-year deal, right? This new Fed facility.
Right.
And so if you have more contagion effect, more banks have issues, they can't, the value of securities doesn't come back, they can't get out of that. It'll be interesting to see what they do in a year, right? Does it become more permanent? Does it become a 3-year that becomes a 5-year? I don't know, but I think we could see that tested. And I think on purpose, they made it just a 1-year duration.
Yeah, I agree.
Yeah. And, we always know that when you want to do something permanently, you start off making it 1 year and you see how long people are still paying attention till 11 months from now. And I think, so 2 things. First of all, the Federal Reserve facilities, I think they're still at this point, the overall amount of lending is somewhere around $300 billion, which is not a trivial sum for between the discount window and some of these other facilities. So there's still a fair bit of liquidity coming. But to your point, I think a lot of that has been against Treasury securities and other things that were at least ostensibly safe at the outset. So it seems maybe even less than taking on the entire moral hazard of the asset portfolio of the bank. What we're actually doing is taking a number of previously different, heterogeneous government assets that we had treated as roughly equivalent for regulatory purposes. And we're smoothing those differences over. We're creating almost one super asset and saying, hey, if we have to raise rates for whatever reason for monetary policy, it's not on you. You are holding it as a safe asset that's sort of amorphous. And so maybe thinking now into the future a little bit, there's been a lot of debates around government digital currency and, how that could be designed and things. And one of the big concerns that I've heard, and when I go to the BIS, it seems to be probably their major concern, is not that it would work poorly, which is, still also a real concern, but also that it might work too well in the sense that you might have people leave the depositor system and cause the same kind of systemic depositor outflow that we're seeing now at a kind of micro level. And the responses I'm hearing from some of them is, well, we can blunt the impact. We can make sure that there's a limited amount people can hold, that there's a differential interest rate so that it's not as attractive for depositors, et cetera. And to me, that's almost like saying, well, we're going to make a car, but we're going to make sure it never goes faster than a horse. And we're going to make sure that only one person can drive at any point in time. It's going to be great. It's going to be amazing, but it's also going to be not at all challenging horses. And it seems to me the other option is to kind of lean in to what this could provide. But in order to do that, to your point, there might have to be a pretty big renegotiation of some of these other things. I mean, what I'm seeing now with the big banks that were very critical of crypto and things is a move towards tokenized deposits on a common chain, which to me sounds like the step before a nationalized deposit. We had national banknotes in the 1860s and things. And if there was some recognition that the the average deposit was first and foremost a public good, there would still be a lot of work for banks of your size to actually do the underwriting and the client relationships and the customer interfacing and all that kind of local credit analysis that is the lifeblood of a proper banking system. But without all of these questions of the soundness and safety of the payments function, that would sort of be not separated entirely, but that part of the system would be essentially taken over by federal government actors to leave the focus on the asset side. And or on the retail kind of, client customer interface side of banking and payments. So I'm curious, do you see from your vantage point this sort of debate about central bank digital currencies and things on the horizon as a threat to your business model, as an opportunity, as sort of a non-event? I mean, to me, the fact that this was all happening at Silicon Valley with a stablecoin bank, and this is the portent of maybe bigger bank-run debates to come, that there is the link there that I'm still sort of teasing out in my own research.
I'm going to plead a tremendous amount of ignorance about digital currency, Rohan. So that's I've been a lifetime,
Well, thanks for keeping me in business, Tim. I appreciate that. I'll have to do some more writing for you.
Yeah. But I do think from a regulatory standpoint, anything where they feel like they lose control over a money supply, over a flow of money, certainly with earlier days, anonymity, those are things that are antithetical to how the regulators view their role, or the Federal Reserve System views its role. And I don't say that, obviously because, what they are in charge of doesn't always work either. So I'm not pretending that it does, but I think that's a degree of change that scares them in terms of losing control over the key factors on which they make their decisions, rate institutions, regulate institutions. I think from what I can tell, they're a long ways away from having that comfort level where they're comfortable regulating it. You see with cannabis as well, where, and some of the digital currency, they say, well, we won't really look at what you're doing here as long as you don't do these things, or we're not giving you guidance. Well, when banks operate without guidance, as Joan said, it's very easy to run afoul, because if you start down a path and start doing something and then they give guidance and it doesn't meet with what you're doing, they just come in and shut it down. And so there's going to be a lot of reluctance with someone that doesn't have the control over that regulatory framework, like a JP Morgan, to say, Bank of Marin is going to start trading in fiat, not trading, but transacting in fiat currencies, just like banking with cannabis. It's really going to be hard to get banks to stick their neck out until there's a clear framework provided of how they can operate safely, because the repercussions of running afoul are pretty severe. So that would be my CEO take on that. And again, with a tremendous degree of ignorance about the topic.
Well, and I think by nature of what I do in operations, I probably know a little bit more than the average bear on digital, but I will never claim to be an expert. It is very complicated. But when it comes to that central bank digital currency, this is something I've actually read quite a bit about. And if we just get back to basics, Rohan, if we just get back to basics of what is it that our banking system provides? And the U.S. banking system is one of the strongest systems on our globe. I mean, it's a vibrant system that we need to be able to move forward and have a strong economic impact. You just take one small community bank in a small town. That community bank is what funds that community. It's what makes it grow. It's what helps it thrive and survive. When you start to take those deposits out, and I agree with you, if we're only going to, and I'll use a bad word, half-ass it according to what they're kind of thinking, then why do it? Why are we going there? So I liked your perspective on that. But even thinking about taking deposits out of the system, a system that provides, those farm loans, that provides those mom and pop store loans, those loans that we actually need. I don't see the government providing those loans on their own. They still need us to do that. So at this time, until there's a better reason for going that route, and by the way, one of the reasons is faster payments. We already have a digital currency. It already exists. Our payments are pretty fast. So I still can't see a reason why we need to go down that path. There's just been nothing justified to do it.
And I think if you look at this crisis, if you were to try to say, hey, the way to deal with the depositor outflow would be to offset it with more liquidity at a favorable rate, that would require the central bank to provide a lot more support to banks like you, which doesn't seem to be as forthcoming as it does to those larger banks that can send 10 times as many lobbyists to Congress. And so the idea of saying, the liquidity that you get to lend out is liquidity that's ultimately publicly backed rather than individual depositor backed is a kind of Rubicon that maybe, we're only 20 years away from the fall of the Soviet Union. It's a little bit too gozbanky for your average American politician in Oregon, perhaps.
You really just go there.
Well, look, I'm the academic. I can say it. You can't say that.
All right.
No, but I mean, so I guess to your earlier point about the safety of consumer deposits, and not to draw a wedge between this great alliance between small commercial banks and consumer banks that I'm seeing on this panel, but do you see a kind of way to reassure individual consumers that their deposits are safe in the middle of all of this, even as we try to work out some of these more complicated questions about sort of intermediate level commercial accounts and things like that? It does seem like the fear that Tim was saying is self-reinforcing, that there was this massive outflow recently and that there hasn't been a strong enough clarity from federal regulators about how they are actually going to ensure a level playing field, even if the balance sheets of your individual banks are healthy.
Right.
It's been hard, I'll be honest, and we chose not to go out public statements early on. And we are 30 minutes north of the Golden Gate Bridge. So this is First Republic country. It's Silicon Valley Bank country for wine lending. We're an hour and a half from Silicon Valley. And so, it seemed like early on, if you raised your head up to say we're fine, you got the he doth protest too much and you just got shot. And so we had a very active customer outreach. Every branch called their top 100 clients. Our gave them talking points. But even then, to most customers, even commercial customers, giving them bank statistics is speaking Greek. If you say my tier 1 capital ratio is double the regulatory well-capitalized ratio, they just stare at me and rightfully don't have any idea what that means. So it's reinforcing the message. If I'm a customer, even in the financial press, even the research reports, from a Piper Sandler, a KBW, or Raymond James, the shops that really do a lot of research on community banks, the average person's not going to know what they're talking about, and their writing is very reactive, right? So it's they're playing catch up too. So really, and Joan said this earlier, meet with your bank executives. If you're with a community bank, have them tell you the story. What percent of their deposits are insured versus uninsured? If it's a commercial bank, they're going to have higher than, or at least industry average, uninsured. Do you have the liquidity and the contingent liquidity to cover that? How is your capital versus the regulatory definition of well capitalized? At least getting those metrics from a comparative standpoint, even if you don't know how to replicate them, is instructive. Reading through the financials. If you look at Silicon Valley Bank's 10K, their annual filing from 2021 to 2022, their disclosures of risk and their discussion of that in the management analysis and discussion were materially different. Right, that there was some red flags there, and it's nobody would ask me if I want to buy a computer, do I need to read someone's 10K? No, but in banking, if you really want to understand, you have to have that conversation, and you have to go to the materials and see how they discuss the risks and how they're dealing with the risks, because otherwise, you're not going to get those regulatory reports, which are the real report card, and so it is very hard for the outside world to look in and say, I want to feel, a very high degree of comfort with my bank. And so it takes footwork. And I would start with talking with people that know. Sorry, Joan, to monopolize that. But,
No, that was great. Obviously, I couldn't agree more. I'm glad to hear you say you hesitated on putting something out. We did too, because that was our thought process. We are fine. We are strong. We are well capitalized. Sure, all of us have investment portfolios, and we, with the rates going up, it's not looking the best, but it's also not going to tank us. I mean, we've been very responsive and very responsible with how we do these things. But those messages are messages we know, and then we have to make sure that we convey them. And so we did the same thing, literally door to door, calling our customers, asking what their questions are and what can we do for them. And we have an environment of, we do that all the time. We actually have been on a campaign to visit with our customers because we want to know how the economy is affecting them. What can we do for you? And then at that same time, talking about the strength of the bank. And so I know that, not everyone on this webinar is, going to run out and talk to their bank executive. I hope you do. That'd be great. We love to talk to you. But it really does come down to that. And not everyone can really, take a bank financial and read it and actually know what it says. I know that it gets complicated and capital levels and what does that all mean? But engaging your bank on a simple risk conversation, you'll get a lot out of that because you'll hear exactly how the bank operates. And that's really where you want to go. What are they doing in the community? What are they loaning out? What are their ratios? What does that look like? So it's a really good conversation to have.
And one last follow-up on this for Joan. I know we have to move Tiffany to the audience questions, so thank you for your patience. So one last follow-up is, you're also wearing another hat, which is the Oregon Bankers Association. And to your point earlier, if there were particular unique aspects about, for example, Silicon Valley Bank, and there is this sort of difficulty of expecting your average depositor to be fully informed about all of these things, to what degree do you see kind of internal industry, not even just regulatory kind of compliance, but being willing to say, hey, we're a little bit worried about this one and we don't want that, we don't want that to rub off on everybody else. To what degree do you see there be some affirmative responsibility for the other banking actors to explain how this is unique rather than, systemic, or to the extent that there are some aspects that are the failure of a particular governance and business model versus others that might be more to do with that large structural problem around the deposit system and the safe assets and the rates and all those kinds of things? How do you, because it must be hard for someone in your position to navigate the fact you're both representing everyone in that industry, but also having to kind of police individual members in that for the safety of everybody else.
Right. Well, so there's a couple of things. And one thing keeps popping up in my mind is education. We talked at the beginning of this, how in 2008, we had to educate why what happened. And I know in my conversations with this particular crisis, I can see that education flowing over. So what I foresee is that we'll just have even more education as to what this was, how do we not make it happen again? And it's not only for the bankers, but it's for all of America, right? It's for our nation. And so I foresee that education's got to take a major role. I think that, we've talked about the regulation piece. We've talked about how we're going to take a step back and take a look at some of that. You've got legislators who are already putting forth, bills that they think will shore it up. And we don't quite know exactly what it is we need to shore up yet, if there is anything. But I think when I think about speaking for Oregon banks in general, number one, plug for Oregon banks, they are very healthy. And so that makes it real easy to speak to that. But also, you've heard me talk about, big banks, small banks, all banks are needed, where we all have a space and we all need to exist because we all carry a role in making this national economy safe and strong, right? And so when we think about speaking for the whole banking industry, we have to take everything into account, but that education piece is going to be huge. And then we are an industry that we absolutely take our lumps, we learn and we move on and we do better. If you think about what we've done since 2008 up until today, our system is very, very strong and resilient. And I'm proud of that. We took our lumps, we figured it out, and we moved forward. And when I look at banks like Tim's and banks like mine and all of Oregon banks, they're doing what they're supposed to be doing. And that focus on the community is so important, especially for a small bank like mine. And so I think that's what I hope resonates with people. I hope that they do go to their bank and talk to their lender and their executives and all of those people and take a really big part in that, because that's where we shine. That's where we can really show you how to engage with us and feel really good about doing it.
Great. Well, speaking of education, it's always the teacher's prerogative to set the question. So I'll hand it over to Tiffany to let the audience ask some questions. So thank you very much for letting me chat with you.
Thank you both so much. We have about 20 in the queue, and I'm going to try and go through this as quickly as possible and lump them up as best I can. I know, Joan, you wonderfully summarized kind of changes that the banking industry has made as a result of some big, 2008 and some other hiccups and things that have really shaken the industry. I will say that a lot of the comments are feeling like the right people aren't taking the lumps. So they're around, specifically, the SVB CEO sold his stock right before they went under. And there's some other things that just don't seem like good actions if we're supposed to assume good intent. And so there's some questions wondering, like, not that anyone is trying to run their institution into the ground or make poor decisions. And there have been some really different situations that we've all been in out of a pandemic and stimulus and all those things. But how do people know that folks are really taking this seriously if things keep happening, or if things from those who aren't as educated in this realm are seeing things that just seem a little shifty in news clippings and stuff with a general low level of understanding?
Yeah. Well, first of all, I would say be patient. We're not at the end of this yet. And so I don't know what the repercussions will be, if any. And they're right. When you look back, I have this debate with my husband all the time, who will argue with me about all of these things, by the way. So, he always brings up, well, none of those executives went to jail in 2008, and then of course I jump to the defense. What are you talking about? So be patient. We don't know what's going to come out of this. But the other side of that is don't judge too soon. I don't know the whole situation. None of us do. And so before we can really get the full story, remember I said I'd love to know what decision was made, and then what was the next decision, then what was the next decision. It will be interesting to see what that is. I hate to jump to that judgment so quickly when if I look at the whole situation, and I mean the whole situation, do some of these things, okay, that might make sense. The other part of it is all of our banks have a unique strategy. Now, usually it kind of borders along the same thing. We're all trying to do the same thing. Our goal is to be safe and sound, but there are certain strategies that certain banks will have. And SVB definitely had a specific strategy that they were employing. And we all know when you have, you want to be successful, and sometimes that does take some different strategy. I'm reading a book right now about Southwest Airlines and some of the insurance companies and the bold steps that they made that everyone said they were crazy, back in the 80s and late 70s. So there was a strategy that was being employed. It didn't work. It didn't work. And unfortunately, we're watching the fallout of that. So I'm interested to see, what was that strategy? What were they thinking? What were the conversations, and how were they going about executing that strategy? So for me, I know I sound like I'm maybe not defending, but I'm trying to be a little agnostic because we don't know the full story yet. And so I think that'll be important once it comes out.
I agree. And Tim, I want to make sure I'm not talking over you if you had anything else that you wanted to add.
No, people don't want to hear this, but banks are run by people, and we have an economy and a culture that chases returns, innovation, exciting things. And while banks aren't supposed to do that, a lot of times banks find ways to bank the people that are doing that. So whether it's, Silvergate with their crypto, focus, or it's Silicon Valley Bank riding the wave of venture capital backed funded startups. Again, they tripled in size. And you can go down the list. In the past, there were people that banked startup airlines and the banking industry. The construct of it is just not designed to withstand the volatility or the nature of overly cyclical businesses. You saw with the S&L crisis, obviously in Texas, in the gas and oil industry. We're not utilities. We're not regulated like utilities, and we're not asked to perform like utilities. And so short of nationalizing banks, there is always going to be a propensity to, if not chase those shiny objects, be a bank for people that are, if that's a growing industry. And so again, back to your question, or Rohan, you had asked, or someone, sorry. How do you tell the good banks from the bad? Look back over time. Have they been a disciplined bank over time through a credit cycle? How have their losses on the credit side performed? Have their loan portfolio performed over time through a cycle compared to its peers? What kind of capital ratios did it maintain? Again, that's not sexy and exciting stuff, but I mean, that is really where the rubber meets the road with the bank. Does the bank perform its mission, just like Joan said, in a way that generates shareholder return, safeguards depositors' funds, is a reliable lender to the business and the individual, the consumer, whatever its focus is, community in its markets over time? Because outside of that, it is very hard to tell. It is just, it's run by people.
And can I, now that I've taken off my moderator hat, can I be a panelist for a second? I work with the Oregon Public Banking Alliance. So to Tim's question about whether or not we're going to make banks utilities, even before we nationalize the entire banking sector, there could be a role for a state public bank to provide a utility-like function, certainly in areas where other kinds of credit are not being provided, or, for example, the kind of leadership on something like cash-based accounts that could work with marijuana businesses and provide the kind of leadership that individual banks who might be concerned about regulatory backlash from the federal government wouldn't want to necessarily be taking the leadership quite rationally for their own shareholders and interests, but to be able to kind of pick that fight with federal regulators. I mean, we're all in Oregon. We can take some Oregon chauvinism on this one. But the other part of it, looking at places like North Dakota, where the Bank of North Dakota, the only public bank in the country, serves almost like a mini state central bank role. And you could have a system that took some of the functions that are currently being served by the large banks that send the funds outside of Oregon, keep them locally, protect those funds, and then reinvest them back in small community banks or credit unions in a way that reduces some of that larger systemic risk or provides some sort of buffer for the banking industry within the state. So rather than necessarily seeing them at odds with local and regional community banks, seeing them as a way to provide an additional level of protection that you're not going to see from the federal level. And so I think there is a sense where that kind of utility function, without having some, large scale structural reform on the US level, can still make individual gains and recognize that, as we are seeing right now with the deposits, that there is a public good function. We don't like to see depositors get hurt, and we want to have every possible solution on the table for protecting depositors, both in regular banks and those who are outside of them.
Well, and I think to that point, we just have to be careful, right? I mean, as you were speaking, it's not that I don't understand where you're going with it, but I do question, if we were to put something like that into place, who really does it moderate? Does it moderate the bigger banks, or, is it banks like mine that unfortunately suffer because of, the perceived protection that may be there? So I always just think we need to be careful with moving forward with those things, but always up for the debate and the discussion.
Thank you. Circling back, again, a lot of the questions we got were people who are very much trying to educate themselves quickly on this issue and make sure that they are acting in good faith on behalf of themselves or family. If someone mentioned a trust that they're listed on for an elderly relative and wanting to know if the online bank that they can't hear from it, that they're not hearing from anymore, is actually a good actor. I know we have something like the Better Business Bureau, that kind of thing. Is there any clearinghouse of information or organization or place where people can go to get some of the information that you, Joan, and Tim have shared that's slightly more digestible than looking at some of those public reports? Because I know I've studied some of this stuff, but I would still it would be difficult for me to wade through all of that.
Unfortunately, no. Again, banks are ultimately measured by their CAMELS rating provided by the regulators, and that is you're explicitly prohibited from sharing that. So if your banker shares it with you, they're breaking the commercial code if you're a state regulated charter bank, or federal regulations if you're a federally chartered bank. But if it's public, there's a tremendous amount of information in their public filings. That is going to be Greek to most people. No offense to any Greeks on the phone or on the Zoom, but it is really hard to understand. If you are managing a trust for someone, I would go to your CPA if you really wanted to understand and have them help you look at those financials. If it's a large entity, it might have public debt ratings. The rating agencies were going to downgrade Silicon Valley Bank. Unfortunately, they didn't downgrade them, so all this already happened. So again, you would have been behind the curve. It's really tough. But getting a comfort level and looking at a trend line, if it's a private bank, you can get their call reports. That's what a bank files, its call report, which is really a financial statement for a bank. But again, you're going to need someone, either a banker friend or I'm sure Joan or I could, help, or a CPA to help you look at it, because it really is hard to ascertain at a point in time whether that's a strong bank or not, just from a set of financial statements. Because if it was really bad, it wouldn't probably exist anyway.
And to go on to that, do you think that is something that might be part of the trust rebuilding or building, that especially like you said, Joan, community banks and others are calling people, educating them, trying to have that feedback loop, that information? Financial literacy is a big topic right now to help people be more informed consumers. Do you think there's kind of a trend to go in that direction?
Oh, I think so. And let's put it the way, I hope so, because I think the more informed we all can be, the better. One of the things that I was heartened to hear when I was back in Washington, D.C. is the fact that the legislators picked up phones and called banks. Usually it's us calling them, right? And so that financial literacy needs to continue and it needs to happen. How we get measured can get really, really complicated, and how you assess whether or not a bank is taking too much risk or if it's healthy or sound, that can get really complicated. So the more that you have those conversations, I think the more comfortable you'll get actually looking at that information or talking about that information. But I even had a customer the other day that called one of my banks and said, hey, I need to know what tier bank you are. And so my officer emailed me and said, what tier bank are we? And I said, well, no, it's not really we're not tiered into a banking system. We have tiered capital. So I was heartened to know, okay, at least they're trying. This is good. Let's have the conversation. It has to happen.
Yeah, I think, Iris just posted something. She's right. If a bank is in trouble and they're operating on a memorandum of understanding or some other action order, first you would want to see who was regulating it, right? If it was state chartered like I am, and I'm guessing, Joan, you are state chartered, you can look on that state website, or the FDIC lists those. Those are public items, but that's just going to be it's great advice. It's just going to be a very small subset of the 4,400 banks out there. And so it's unfortunately a homework project of it.
And on that point, I think, while there's it's easy to hate on banks per se, but there are so many other financial institutions that are far less transparent and regulated than your average depository institution. Working in the crypto world that I do, the kinds of collapses there that we've seen the last few years just dwarf the problems even at Silicon Valley Bank. And so the first thing is, however you might be concerned about wherever you're putting your money, put it in a place where there is a history, there is a track record. And certainly, as Joan said earlier, that you can actually call people and get a person on the other side. The community banks in Oregon are not Wells Fargo, and they are certainly not, FTX or Tether or Binance or any of these kinds of opaque actors who have technical troubles every time there's a problem. And even I respect your ecumenical approach to saying all banks are necessary, Joan, but there even are differences between the kind of banks, right? Trust kinds of banks, industrial loan banks. There are certain charters that have existed precisely to get around some of the transparency that you're all sort of submitting yourself to in the name of accountability to your customers. So I think, choose the right bank, choose the right kind of bank, and make sure you can get people on the phone.
Speaking of choosing, a couple of people mentioned credit unions, because those tend to come up, and people so far, that name has not been attached in a news headline usually. So, do you find them to be generally an acceptable banking institution or financial institution for the average consumer?
Well, they don't pay taxes, but I'll get over that.
I was going to say, boy, Tiffany, you just went straight for it.
I know, I'm jumping.
What's your fiduciary responsibility to respond to that, Joan? I'm not actually sure.
No comment? No.
There are very, very well-run credit unions, and obviously obligated to operate on behalf of their members, right? They tend to be more consumer-oriented banks or institutions, the ones that I have more direct knowledge of. And so we're much more of a commercial bank. And so I don't necessarily directly engage with them. So the amount of lending they do in areas that might be a little more susceptible to commercial cyclicality is down. They are big, consumer lending focused banks. And so I'll let Joan comment. I'm guessing she runs into them at their size more than I do, but it's I don't see them as much in the commercial world. And so I again, despite my comment about taxes, I don't know enough about how they're affected by these kind of things.
And I will also, on the regulatory front, I will plead the same, I guess, sort of ignorance. I'm not sure. I believe that they are subject to pretty much the same regulatory fronts that we are. I don't know about the standards that they're subjected to. I will plug in all the taxes, though, that they don't pay taxes. But I think Tim's right. They are at least supposed to function more on that consumer side. I will say in the world of Oregon, we do find that some credit unions try to foray into that commercial side. I won't say that they do it well. Your commercial bank is still the one who needs to be the one you go to for that. But certainly they still need to hold some of those standards as well moving forward to protect the consumers' deposits.
They have a lot more granularity than most of us commercial banks because of that consumer focus, and so they're again less directly affected by some of these types of crises. Not all crises, but something like this, yes.
And as someone that advocates for public banks, I won't get in the way of nonprofit tax-exempt entities as an intermediary step. I do think I saw one thing that described the Silicon Valley Bank as almost a credit union for Silicon Valley in the sense of their entire business model being so industry concentrated. But I do, in the work that I do around, for example, liquidity provisioning, my understanding is a lot of these credit unions end up having to buy deposits from larger banks anyway, and that there is a kind of almost tributary function that they serve under larger rivers of liquidity, and that it isn't really a solution to some of these structural under-provisioning of liquidity issues that we were talking about at the outset. You're not going to get greater deposit safety at the margins of the banking system than you are closer to the core. And whether that's fair or whether that is another example of a kind of inequality of regulatory treatment and everything else is a separate question. But if we're trying to deal with the safety of the system, in my opinion, the question is how we get that beating heart of liquidity out to everybody on a fair playing field. And at this point, at least, credit unions seem to be almost even lower on the hierarchy than some of the other actors that are already suffering from liquidity issues.
Well, the industry is so disparate in that, when you're talking about Silicon Valley Bank, Signature, even Silvergate, those are commercial banks, right? And so that they are, while some of the key underlying factors and variables that affect us all drove some of what happened, it was unique to those commercial customers. For example, the VC-backed startups and the VCs that they banked and invested in, and that ecosystem you mentioned that was so closely intertwined. And the same is true for all that. I think Signature was the biggest commercial real estate lender in New York. So it wasn't just exposure to crypto. It was exposure to what is now viewed as riskier deposits and lumpier, to use a banking term, lumpier lending in New York, where New York, like San Francisco, still has a high degree of work from home, rolling vacancies, things like that. And so there was a lot of fear that drove out taking big deposits, and you don't see that with a credit union, and that's why you're not seeing it with some of the bigger money center banks that are more consumer oriented. We all seem the same, but we're really, really not.
So I know we only have a few minutes left, so I'm going to try and do some rapid fire things, considering that we keep talking about safety of other people's funds and things. A lot of people are asking about the safety of the dollar or the value and stability of the dollar, and particularly looking at how China has been working with different countries to replace the US dollar as a global reserve currency. I don't know if this is such a big question, but I don't know if you have any thoughts on how that might be coming into this, or might be on, kind of foreshadowing another thing that people could be worried about or be considering.
Well,
Joan, you got this.
Yeah, I got it too. That's a big question. And it's not that the banking system and what's happening to it in the US doesn't affect some of those values, but there's so many more things that go into the value of that dollar. Heck, wars that we're not even involved in go into the value of that dollar. So it's hard to say that, something that's happening in the banking industry is what's driving the dollar down. And yes, certainly some of the actions that China are taking are having a strain on that value. It's one of those things where I don't actively engage in the value of the dollar on a daily basis, so I can't give a definitive answer. But that's a really big question, and one maybe we'll have another webinar where we can really invest in what goes into the value of the dollar, because it's pretty big.
Yeah, I'll take foreigner privilege here. As long as there's 200 plus US military bases around the world, as long as the US is funding the IMF and the World Bank and WTO, as long as they have most of the international financial contracts denominated in New York or London, and that remains the center of the English-speaking financial system, I don't think we've got anything to worry. There are reasons why a weak dollar can be beneficial for parts of American industry and worse for others. That's a trade-off that the Chinese are playing as well. And even today, as I said earlier, the swap line network of international currencies that was started off with 6 countries, which was the US, UK, Canada, Japan, the ECB, and then ones not like the others, Switzerland, was lending to each other. It's really a first amongst equals with the US at the center. It's the new Bretton Woods with the US dollar in a slightly more elastic relationship, but still fundamentally at the top of the entire rest of the world. And the fact that China just did this deal with Brazil to settle payments between each other outside US dollars, it's still a very small fraction of overall trade in the world. And even if a lot of trade was to settle elsewhere, the US dollar continues to remain hegemonic for all sorts of geopolitical reasons. So I wouldn't look at this as a major driver.
Yeah, I would, what Rohan said. But this is very different than the Great Financial Crisis, right? I mean, this affected the 16th largest bank, which was the second largest bank failure. And Signature wasn't even on that top 25 list, right? And so really the top biggest banks that are 80% of, where deposits are held are really operating fine. And they've actually benefited from this. And I'm not pumping up my, really large bank brethren. But in terms of something that would really threaten the value of the dollar, not questioning the geopolitical, components of that question, our money system is not at risk. It was just a crisis of confidence that really started hurting regional banks and smaller banks like Joan and I's, as opposed to the money center banks that really, at the end of the day, drive the economy.
If anything, failing to deal with this crisis would have done more damage. I think the response certainly wasn't the problem.
So with that in mind, final question then is really, we've had the immediate response, but what do you think might be coming, especially from your perspective, for small and community size and commercial banks in the future when we look at regulations? Like, what do you think might be headed your way? And as the situation changes, what are you all considering looking ahead?
Let me go first, then you can have the last word. I'll put my educator's hat on, which is, I think bad cases make hard cases make bad law, right? I think to the point earlier about educating people, a simpler financial system, one that is easier for people to understand, is one easier for people to get involved and hold people accountable and ask the right questions. So putting aside the fact that this system is inherently complicated and will remain complicated, thinking about solutions that bring stuff to a level that we can actually understand and educate large numbers of people. So I would love to see a big conversation about what it is we want out of a checking account. Just what it is we want from a checking account. Just a really simple idea, whether it's a small person or a big bank or a company or whatever else. What are the guarantees? Just renegotiate that social contract and then build something out from there.
Yeah, I think I think it becomes, we become obligated to do a better job as an industry, right? And I think as one response, I don't think the regulation will trickle down to banks our size in terms, we're a $4.1 billion bank. Joan, you guys are right, just under $1 billion, is that right? Because they really can impose those. But I think what they'll do is they'll get a lot more rigorous in how they do look at what they look. That happens every time, right? And there's a lot of, there were 20 regulators living full time from one regulatory body at Silicon Valley Bank. It's not like they weren't looking. They just weren't looking hard enough or executing on what they did find. there were findings going back to the end of 2021. And so what I think, from a small bank, they won't be able to say, you have to have this ratio. But what they'll look at 3 or 4 things and say your capital's this, and your liquidity's this, and your unrealized losses in your investment portfolio is this, and we can either live with that in totality or we cannot, and here's what you need to do to remedy that. I think they'll be a lot more rigorous with us in that process. I had my state regulatory exam in January, which at the time I was whining about because it was right after the first of the year. Now I'm super happy because I know if it was next month, that would be very, very different. And so I can't say in what form, but they will hold us all accountable, and there will be increased, obligations to prove that we have the safety and soundness that they expect. And that's just the normal cycle of how these go. Joan, I don't know if that's been your experience, but that's been mine.
Yeah, that's exactly what I expect to happen. No, I don't foresee banks our size having to submit to any necessarily new regulatory standards by any means. Possibly something for the bigger banks. But my exam is next month. Thanks, Tim. But I am looking forward to it from a standpoint of I want to have those conversations. I absolutely expect them to look at a couple of extra things, to ask a couple of extra questions, probably more than a couple. But for a banker like me who wants to be accountable and wants to do it right, I look forward to that because that's exactly what we should be doing in our industry to make sure that the future is where it should be.
I appreciate everyone and your perspectives, and even handling some hard questions from those of us who don't know the industry rules and are just hearing clips on our drive into work and everything else. We are 3 minutes over, but we still have time if there are any final thoughts or things that you want to share or wrap up before I sign us out for the evening. So I will offer it up if there's anything else you think we didn't get to or that you just want to touch on one more time.
I just want to say thank you guys for including us. I regret that it took this all happening to get invited to do this. No one has asked me since I graduated, tell us more about banking. So I appreciate.
You shouldn't have said that, Tim. I'm going to make you come to my classes. We don't pay as good per hour. No,
that's okay. I appreciate the interest, and it is a confusing industry. And honestly, if people want to eat, Tiffany, the team has my email. It is hard to understand, and when you have something that dominates the headlines and makes it sound like you're going to lose your life savings or your business is not going to be able to make payroll, it's terrifying. And I get that. You have to be on the inside, like Joan and I, to know that that's really relegated to a small subset, but it never feels that way once the news cycle takes off. And so, as she said before, the industry is on good footing. It's a much stronger industry today than it was going into the last financial crisis. It'll be stronger coming out of it. But don't feel bad that you feel uneducated about it, because it's really hard to understand if you're not on the inside.
Yeah, I would agree. I would echo the thanks. Thank you to everyone who tuned in. Again, I am also an educator. So from that standpoint, I love that you are curious and that you want to learn more. I've seen some chats that say, thank you, I'm going to go do my homework. Please do, and call your bank, have those conversations. So thank you again.
Thank you so much. I appreciate both of you.
Thank you, everybody.